is Kobi Carlebach, and I'm very happy to be here today. I'm going to talk to you about how statistical-based model can help drive business performance. So before we dive into our presentation, I would like to shortly describe the business environment in which my company operates. So imagine the following business environment. You pay huge amounts up front, which is very difficult to understand how much you will earn over time. You have tons of data and tons of combination of data. Most of them even come from different sources. And to add on that, the industry is extremely changing, and changes in the industry can impact your ROI and revenue forecast. This is a challenge that many internet, mobile, and SaaS companies are facing. And to add on this, the main issue also is that most of your financial metrics, the basic metrics such as revenue, gross margin, etc., do not help you to understand your business performance. And the main reason is because you're investing money up front. Let's say you are a SaaS company and you want to acquire users. So you are doing a campaign which you acquire a user, and hopefully you hope that some of the users over time are going to be paid users, and then you have some kind of churn. So you have a first month, you have a negative cash flow because you invest to acquire the user, and over time you expect the user to generate a cash flow. And hopefully the cash flow they will generate is more than what you're paying. So what usually happens, you invest in the first month, you have a negative cash flow, and then in the other months you have the positive cash flow. So what happens, let's imagine two types of company. One company is a very successful company which has a very positive ROI, and as a result, this company decides to accelerate their customer acquisition cost. As a result, what happened, this company invests more money in customer acquisition because the first month is very negative, so they have a negative cash flow, higher negative cash flow, and as a result, when you look on the company financial, you see that the gross margin of this company is going down. Another company, it can be a company that is not so successful, and as a result, until this company resolves its problem, this company decides to stop their customer acquisition. So what happened is you stop your spending, your revenue are based on your previous user base that you acquired, so you're living on your tail revenue, and as a result, your margins are going up. So if you don't understand the business and you're looking on two types of company, the first company looks like it's not in a good situation because the gross margins are going down, and the other company looks like in a great situation because the gross margins are going up. But the reality is that the conclusion is opposite, because your main asset, which is your user base, the revenue tail, and the customer you acquired, is not part of your financial statement because you need to expense your customer acquisition. And this is why it's very important to understand the business and to have some kind of tool to understand whether you're doing good or you're not doing so good. So a little bit about Perion. So Perion is a fast-growing internet company. We are traded in the NASDAQ. We have a market cap of roughly $500 million, and we offer to application developer data-driven solution across all platforms. We help application developers to promote their application, to monetize, and to optimize. So in the promotion, we are talking about, we have the Perion Lightspeed, which the Perion Lightspeed help application developer promote their application, engage their audience. You know, when you want to, for example, you build an application and you want to distribute it. So there are different places you can do it. You can go to Facebook, you can go to Google, you can go to different ad exchanges. So you need to have a good understanding of the business in order to do so. And also, each platform has its own audience and its different costs. And in many cases, you need to connect to the platform in order to use it. So we are saving them time, and we are offering them to use our platform. And then, based on their category and which audience they would like to reach, we offer them which platform they can use. And also, we give them some kind of guidance about the range of the prices they should bid to get the traffic. In the monetized, we are talking about the Perion Codefuel, which is my division. This is the monetized division. We offer the application developer to get to earn from the digital asset, to boost their ads revenue, and to show revenue growth. And in the optimize, we offer the application developers to optimize their campaign We offer them a smart analytical platform that can be used to do A/B testing to understand what is working and what is not working, and how they can improve their conversion and to make more money. We have around 500 employees in 4 locations. We had revenues last year of roughly $325 million. And we are between the 4th and 5th largest market share in the US search market. So after Google, Microsoft, and Yahoo, we are and Ask are more or less in the same place. Feel free if you have any question to stop me. A little bit about myself. As I said, I am the Vice President of Business Control and Operations in Codefuel, which is the Perion Monetization Division. I am originally a certified public accountant. I am leading all Perion business activities of the Codefuel division. Among other, I'm in charge of setting up business model and pricing, monitoring account performance, and also providing mid and long-term forecast. Prior to working in Perion, I spent 7 years in Amdocs. Amdocs is a leading global telecommunication billing company. Amdocs serves most of the US largest operators, for example, AT&T, Sprint Nextel, T-Mobile. So in this operator, most of our operators use our billing system. And prior to that, I worked 5 years in PricewaterhouseCoopers as an audit manager. So let's go over the challenges that we are facing. So the first challenge, as I said, is that we pay upfront, and it's difficult to know how much you will earn over time. So we are basically in the monetization business. Most of our business are upfront business, even though we have some of the business which is a rev share business. But I'm referring mainly to the, let's say, the complexity of paying upfront. So we acquire a user and we pay upfront. It can be based on installs. It can be based on clicks, user impression. And the main question is, we generate revenues over time. And what's the total value of the revenue we expect to generate? Revenue can be generated from search, ad impression, second offer, shopping apps. In the SaaS industry, revenue can be generated from subscription-based model. If you're an application developer, you might have in-app purchase. But the main issue is that you have disconnect between your initial investment and what you expect to earn over time. Second challenge, we have a lot of data, and many of the data come from different sources. So we analyze more than 12 terabytes of data every month. We reach over 380 million users in 130 countries with 18 languages. Our ad network serves over 7 billion ads on a monthly basis for 40 countries. And the user generates over 50 million installations per month. If this is not enough, we need to look on the data on very different cuts and slices. We look on it on a browser level, on a search provider level, different geography, different accounts. So we have a lot of data, and sometimes having too much data is a real problem. And last thing, our industry is rapidly changing. So we have ongoing changes in our industry which are very difficult to anticipate. For example, I gave you a few examples of some kind of articles. One is browser changes. For example, you can see here the Chrome releases. So every few months, Chrome, Microsoft, Firefox issue a new release of the browser, which has different challenges, a different way to work. We have issues with privacy laws, that privacy laws always get clarified, and we have changes in privacy laws. And also there are changes between the search provider rules and behavior and also the market share, which all these changes might have an impact on our performance. So the main question is, how do we forecast? Okay, 1 minute. I like this slide very much. And the question is, how are we going to roll the dice and do it Vegas-like? I guess our investors don't like this slide so much, but this reflects the main challenge we have in our business, okay? You invest money up front, you invest based on a certain expectation about the behavior of your users, and you have a lot of uncertainty along the way. Some of the uncertainty are external, for example, browsers, search providers, some of the competitors, and some of the uncertainties are internal. But you have a lot of uncertainty inside your business, and you need to know how are you providing a forecast. So the answer is not doing a Vegas-style forecast. The answer is to build a system that knows how to handle the three challenges. So we're talking about a system that knows how to calculate user lifetime value, both in the beginning and ongoing basis. Having a system that knows how to calculate lifetime value is not only relevant to my company. So in general, every company that needs to understand the lifetime value of the user in order to invest money, it can be an application developer, it can be a SaaS company, has to have some kind of system that knows how to calculate lifetime value. Perhaps if you're a SaaS company, it's less complicated because you only need to take into account the user churn, and the user churn can be affected by pricing, competitors, products, etc. In our industry, it's a bit more complicated because you have a lot of moving parts. So you have like the user churn, you have the search provider performance, you have competitors, you have agreement changing, so you have a lot of things going on. What we are also doing, we are doing a focus on tracking actual performance, because what we have realized is very similar to Excel. People who are statistical guys are not always connected to the real world. So you can get results that are very different than what you expect. So you can have a model that's showing that you are making a lot of money. But if you look on your bank for this specific cohort of installation, you see that you are not getting as much as you expected. So we're always looking on the actual, because we know there is some kind of a return pattern. For example, if you invest in the first month, you invest X, you expect to have in the first month 20%, in the second month 20%, etc. So you can look on your return, and if, for example, your return is more than 20% in the first month, you're probably going to make money. If your return is less than 20%, you're probably losing. And you take this and you compare to the lifetime value to see if it makes sense. If your return is very low, while the model shows that you're making a lot of money, there is a problem with the model. So you always need to make sure the model works. To solve the second challenge, which is the amount of data we have, what we have done, we're taking a system that consolidates all the relevant data into one format, and the forecast is done on a group level. Because we're talking about so many data, it's not so practical to do it on a single user basis, and also from statistical point of view, once you have more data, the numbers makes more sense. Feel free to ask me any question. I'll also give time in the end. And also, the statistical model adjusts itself to the industry changes. So as I said, there are many changes, and it's very important that the model will know to identify outliers and to adjust the forecast accordingly. So if for example, we have a performance and we are now in December. December is US shopping season. As a result, if you're in the internet industry or you are in the advertising industry, everyone knows that in December, everything is going up. RPM are going up, CPM are going up, CTRs are going up. So the performance of December do not really reflect the performance that you expect to get in January and going forward. So it's very important that the system will know to identify it and to give let's say, a revised forecast for the rest of the year based on the normal run rate. So we are using the system for two reasons. The first reason is that we are using the system to provide our pricing. So we have the model. We have the model that gives you some kind of indication about the average lifetime value of a user in different geographies, and we use it to set pricing. And the second use of the system is to monitor account performance. So we can look at a specific account and see if it's profitable or not. If it's profitable, we're trying to see what we can do to get more traffic. If it's not profitable, we're trying, first of all, to optimize, to understand what's the issue. And if it doesn't work, we either terminate the account or reduce rates. I see the system that we built. The system we have built is very similar to brakes in the car. And let me ask you a question and answer by raise handing. How many of you think that the purpose of brakes in the car is to stop the car? Okay. How many of you think that the purpose of the brakes is something different? How many of you are too tired to think? So, most of the people think that the purpose of the brakes in the car is to stop the car. But this is not the purpose of the brakes. The brakes in the car, they actually help the car drive. Because let's assume that you are getting a car and you don't have brakes in the car. So you're either not going to drive the car, you're going to drive it very slowly, so you'll be able to stop the car in any given minute by your leg or whatever. Okay? But because you have brakes, you know that you can drive the car, you can accelerate, and you have the ability to stop in any given way. So very similar, this is our system. Because let's assume that we didn't have the system. So we will have to do everything very, very slowly. So you had to acquire some customer. You needed to wait a month or two to see how it works out, whether you're making money or not. Then after 2 months, if it's working, you can accelerate your spending. If it's not working, you can do adjustment, acquire a new customer, and see how it works. So it means that you will have to work very, very slowly because it takes time to understand the performance, to see the real results. And by doing this, you're probably not going to succeed. By having a system which gives you a good indication on the same day, and of course this indication improves over time, you know that you have the ability to understand the performance of your business and to accelerate. We are talking about a business that we invest roughly $200 million in customer acquisition on a yearly basis. So it's a lot of money. And this system gives you indication whether your spending is good or not good. And this gives you the ability to take more risks and to be more bold. And if we didn't have this system, we will have to work very, very quick, very, very slowly, hoping that things will work out. And this is not a good place to be in our industry. So you need to have the ability to take risks and to adjust your course of action if needed. So I would like to show you a few dashboards that we use in our company to understand the business. So first is example of lifetime value and ROI dashboard. In this example, we did it, we reflect the cohort based on a monthly basis. You can do it on a weekly basis. This is a network level. You can do it for specific accounts and specific countries. And what you can see here basically is the blue line shows your payout, how much you pay to acquire a user. And the red line shows what's your estimated lifetime value. And you can see the margins. And of course, positive margins is always good. What we see here and what is missing in this dashboard, you only see the model. Okay? So the model, as I said, is comprised of actual results and it's comprised of forecasts. So you also want to see, let's leave the model aside. I would also like to see how the cash looks like. Okay? I want to know I invested in the first month X, and now is the return being generated every month. So we have another dashboard, which is the cash on cash dashboard, which this dashboard, you can see your spending on a monthly basis and how much you can see here. This is the first month, okay? So in the first month, here you have the cohort. So each line represents an installation month. So this is, let's say, January spending. And you can see how much you returned every month. So you can see there is some kind of pattern of return. So you can see, for example, that the black line has a higher curve than the other line. So you can see that in February, let's say your spending was better because your return was higher. So what you see here, for example, you see that on the first month, on average, you are returning 25% of your investment. After 2 months, it can vary between 30%, which I guess is a very bad spending, to over 50%. So this connects your lifetime value into actual numbers. So you can see here how much you returned, while in the previous slide, you can see the overall LTV. And of course, there is connection. As I said, if you see here in this slide, you see that the best line is the black line, okay? So you expect that February spending is going to be best. Afterwards, you will have January and March spending. And you can see here that, let's say, sorry, wrong slide. So you can see here that February spending is the best. Then you have like January and March spending, and the rest of the spending are a little bit less. About the architecture of the system, as I said, we have data on a user level, which the data is being aggregated from different sources. So we take all the data on a user level, and we put it in an analytical layer that helps to take all the data and transfer it into one source that can be used in the system. Then we have the prediction system, which is based on Hadoop and OBIE. And the prediction system is being run on a daily basis. So we take every day all the data from the installation date until the day the system runs, and we always adjust the forecast. So you can say, you can have in the beginning forecast of X, and after time, as time goes by, you can see whether it's X plus something or X minus something. And then the forecast is being done on a group level, which you can do different slice. You can do a slice for a product, you can have account, you can have geo, etc. This infrastructure is very convenient because, first of all, it reduces the amount of data that you need to forecast. And the forecast is more accurate because when you group data, you get a more accurate forecast because you have more numbers. Okay? In respect of the model, as I said, the model continuously being updated. So the lifetime value of forecasts are always updated also for historical installation date to always reflect current performance. So let's say I spend in January X per user. After 1 week, I get an initial lifetime value forecast. And over time, as the user paying subscription, generates search, doesn't really matter, your lifetime value is always going to be updated. So let's say if the churn is lower than what you originally thought, the lifetime value will go up. If the churn is higher, your lifetime value will go down. So the system is not static. The system always updates the forecast, which is very important because you cannot, even though after a week or two, you can get a very good indication about your lifetime value, you want to always check that over time, your lifetime value indeed is correct. And this is a method to validate your model. So let's say if your model always gives you, in the first month, lifetime value of X, in the second month, X minus 5%, and in the third month, X minus 10%, it means that your model is not good enough because you have overestimation, okay? Sometimes there are external factors that impact your model, but as long as there are not material changes outside your industry, you need to make sure that the model more or less reflects and there aren't any significant changes from month to month, okay? Another thing which is very important, the model auto-updates itself based on actual performance and industry changes. So let's say, for example, and I'll give you an example. Let's say, for example, that you have the blue line. The blue line shows you some kind of a churn. It can be a user subscribing, it can be searches, it could be ads, whatever. And you have some kind of churn, and your original forecast after 120 days was the red line. So this was your original forecast. So let's assume that something happened. In this example, something happened around here, and you had a drop. I don't know. You lost users. So if you're a SaaS company, let's say that one of your competitors offer a free trial, so some of your users left. On the other hand, for example, you can have a positive impact that you have like the holiday season and something went up. But what is important is that the system understands that something here happened, and instead of crashing the forecast, let's say having something like this, it understands that something happened, it looks on the recent period, and then it provides you an updated forecast that takes into account that you lost some of the users. This is very important because this gives you the ability it gives you a system that knows how to identify changes and to make sure that your models are not going crazy when you have changes. And in our industry, we have changes all the time. You have holidays peak, you have competitors, you have browser changes, etc. So this is what I have so far to present to you. So feel free to ask me any question. Any questions? Yeah. Historically, we look about, the forecast is within 5 to 10% variation, which is quite good. So sometimes we have, let's say, positive impacts. So we have like things happened better than what we anticipate. We moved from a certain search provider to another, which gave us, let's say, a more economic value. And sometimes we had a negative impact. But overall, I think most of our forecasts are within 5 to 10%. Also, when we are doing the forecast and also the pricing, we only take into account the first year because we want to be conservative. So we know that even after the first year, even if you're, let's say, a SaaS company or whatever, users continue to pay. But in order to be conservative, we prefer to have this as an upside. So let's look on lifetime value in the first 12 months. This is our benchmark, and we need to make sure we're making money on it. All the rest is just an upside. Yeah, so let's say I said in the first month X. After 1 year, it will be X between 5 to 10%, which I think, given everything that is happening, is quite amazing. We invested a lot of time in the system. Also in the implementation, we had all kinds of questions because, lifetime value is, in our case, for example, is comprised of how many searches a user generates, what's the average revenue per search, how much revenue you are making from ads. And what we decided, for example, is instead of modeling the lifetime value, the main impact on the lifetime value is searches, okay? And searches tend to less variate than RPM. So we are modeling the searches, and then we layer in, on top of the searches, we apply the RPM and the ads part, etc. And this gives us more flexibility because, as I said, RPM, that in the holiday seasons, RPM are going to go up. So we originally chose a variable which is, let's say, more general, this is the biggest driver of the lifetime value, and the model is based on it, and then the model applies all the calculation to get into a lifetime value. No, we don't price real option. So we are basically pricing, because we are in the monetization business and we are acquiring traffic, we are mainly a B2B company, so we want to value the lifetime value of the user and to make sure that we are making money. If I pay X for these users, I want to make sure that I'm at least getting X plus 20%. Yeah, so there are you have a big customer and you can use, for example, the customer base. You can use the customer behavior, for example, to know their ad performance. You can use this, what we're doing a few trials, for example, to be able to use the, let's say, customer behaviors and to use this to acquire traffic in ad networks. So this customer has tendency to buy X, so you can bid for this ad and to pay a little bit more because you know something about the user that other, let's say, competitors don't know. Yeah.
Is your forecasting tool actually an internally developed tool, or is it a bolt-on from one of your major ERP or CRM systems?
No, it's built internally. I think that they are using some kind of statistical model to build the model, but the tool is built internally. We are using OBIE as a way to reflect the data in the dashboard, but it's all been done internally. And this is the OBIE is just the front end of the system.
Have you and your team been directly involved in developing and writing reports for the output?
Yes. So what happens? First of all, we understand that we had to have the need to show the actual performance and also the forecast. So we had a big team which was comprised of statistical people, BI person, IT, etc. So we, as finance, led this project. We defined the needs, and then the statistical guys build the model. The BI team make sure that all the parameters we need in the different slides, the actual, the forecast divided into months, weeks will be part of the OBIE. And then we together build the report that we needed. And also we are currently on a constant basis to, let's say, first of all, to improve the model. So we are doing all kinds of add-ons, for example, disaster recovery. We are adding cross-validation to the model. We are adding different slice and cuts. We have like different products, different search providers. So we have like, the engine is working, but now we are doing enhancement for the engine, which I guess, when we started the project, we thought, okay, it's a 3-month project. We're like in September. Okay, we'll finish in January, February, March. We started in September last year. We are still working on the tool. So, let's say in most of the cases when you design something like this, there are a lot of obstacles along the way which you didn't anticipate. For example, you were working on a certain search provider, and now you have an additional search provider. So to implement another search provider is very difficult. Now you have new products. So everything, we try to do it, first of all, as generic as possible. So it will be, we'll have the ability to add new product, new search provider, rather than rewrite this. But it still takes time, and it's not perfect yet. But without this system, we wouldn't be able to take more risk. And what is very important, we had one source of data which both the sales teams and the finance team feel comfortable about. So what we had in the past is we had, let's say, the sales team had, let's say, low confidence in what we said because they were looking at the financial statement. Financial statement, you have, as I said, our business is comprised of users that you acquired in the past. So most of the revenues, let's say, in a given month, let's say now I'm starting in September. So let's say 85% of the revenues that I'm going to generate in September comes from the tail, okay? And only 15% is new users. So the sales team always were looking at a financial statement and say, look on your business, we're making tons of money. So how do you say that this customer is not profitable? So they had a very low confidence in what we are saying, which was very difficult because we're telling them, kill this customer, reduce this rate, etc. And they say, I'm looking at your financial, we're making tons of money. And then try to explain to them that this is old users you have. So when we build the system, we make sure that everyone are using the system, the account manager, the sales team, and there is one source of truth. Because it's not a good position to be that someone has his own calculation, they have their own calculation, then they're trying to reconcile. He's saying that we are making X, I'm saying we are making Y, and then you need someone to decide. So we had a system, everyone are using the system, and what I'm seeing is also what the VP of sales is seeing and what the customer account manager sees, which is very important. Yeah.
Are you able to profile prospective clients as to LTV?
What do you mean profile prospective clients?
Can you give insights back to the sales team that say, if you're looking at prospective clients that look like this, we can tell you what the potential LTV is?
Yes, so what we are doing, we try to take our network and profile it based on segments. So if you have, this is a gaming segment, this is the arbitrage segment, this is the ISV segment. So we give them some kind of indication which is segment basis. We can give them, we have a generic pricing. As I said, we can use the system to get some kind of a lifetime value and we use it to price. Sometimes we look on a segment basis, some segment has a better performance than other, and this is used for pricing. And then we give the sales team an indication. We also built a system which is used to produce generic pricing. So let's say the sales team, they go into the Salesforce. We did a lot of enhancement into the Salesforce. They go and create a quote themselves. They just input all the parameters. What's the rev share I want to give? What's the segment? What's the business model? Blah, blah, blah. And they get a quote. And then they can go with this quote. They can also get a contract. They get a quote, they get a contract, they can go to the customer without the need of us, go to sign it through EchoSign, and they have an agreement. They are doing it itself. And this is the first part. The second part is after this customer goes live, the monitoring part begins. So you start looking on your forecast. Okay? In the beginning, you have only the actual data, so you can see and you know how much, first day, if you're doing X, roughly what does it reflect. It's not accurate, but you can, you know, you can see whether it's okay, disaster, or very, very good. And you don't kill a customer in the beginning. Then you wait a week or two and you start seeing the actual numbers. If they are good, everything is okay. If they are not good, you're trying to understand what is not working good. You're trying to, let's say, optimize, to make sure that you can do changes that can boost the performance. If it works, great. If not, we need to either reduce rates, terminate this account, etc. But there is variation between users. You know, it also depends a lot of where do you acquire the users. If you're doing campaign in Google AdWords and going to a certain website, you can have a better performance than going through other websites. So let's say users that tend to install many things are, let's say, less valuable users that don't install many things. So it depends on user. And sometimes it's very difficult to understand what would be, you're getting a new customer, it's very difficult to understand what's your user lifetime value. So you have to try. If it works, great. If not, you need to go to another customer. Any other questions? Thank you very much. I will be in the break if you have any other questions.